All right, we'll get this started. Thanks for joining us on the webinar today. I am actually going to record this video, so if you do need a recorded version of this, I can send this to you afterwards also. But what we're going to learn today is some first-time homebuyer money. There's the new FHA loan program out there. Actually, it's not new. It's just they're just revisiting the program. But it's kind of an interesting product. It's certainly not for everybody, but it is an option. And that's really all we want to offer our clients is options. Again, sometimes it's not for everybody, but as long as we can provide opportunity and options, I think we're doing our job. Let's dive in and get the webinar started. My name is Peter Wright. I am the owner of Essex Residential Mortgage. I've been in the mortgage business a long time. I'm also the co-host of the Real Estate Radio Show. We've been doing that for about 8 years now. And I take a special interest in credit, not necessarily credit repair, but credit education. And out of that, we formed another company called Rock the Score, which is actually very interesting. It's a rent reporting company. So we actually report the rent for tenants when they pay their rent on time. And that organically increases their credit score, improves their credit profile, and ultimately it's going to turn more renters into buyers as a result of doing that. So it's kind of an interesting program, and we have been doing that about 3 years now, and we enroll clients all over the country every day for rent reporting. And it's a really cool program. It's a fun business, and it's obviously creating opportunity. What you're going to learn today? Well, we have some first-time homebuyer funds, and we're going to show you what locations those are located in and how to access the money. Who qualifies for the money? There's eligibility, guidelines, rules. We're going to run over those real quick. New FHA loan program, as I mentioned, not really new, but rehashed, I guess. But it is kind of a cool program. And how credit works and tips to help your clients improve their credit scores fast so you can turn them into a buyer. A few misconceptions with the first-time homebuyer money. You need perfect credit to be eligible for the program. You do not. We're going to review the credit scores that you are going to need on this. These transactions, full of red tape, they take much longer to close. Actually, they don't. Buyers need to be a first-time home buyer to qualify. This is a big-time myth. You actually don't. So you could have been a first-time home buyer before. As long as you do not own a property right now, you qualify again. You kind of grow back your eligibility as a first-time home buyer as far as these funds are concerned. So that's kind of a neat fact there. And interest rates on these loans are much higher. They're really not. They're the same interest rates. Obviously, rates are going to depend on a number of different things, including credit scores, which is why we put such a big emphasis on credit, because the better the credit score, the lower the interest rates, the lower the closing costs, the easier it is to get people qualified. So we do really put a lot of emphasis on credit and helping people with their credit scores. Let's review the grant funds. These funds are issued on a first come, first serve basis. And there's money available in St. Louis County, St. Charles City and County, Jefferson County, St. Louis City, although the funds are almost used up in that area. Florissant has its own money. I know that's a part of St. Louis County, but Florissant itself has its own funds. So if you're in the city limits of Florissant, there's different rules, different funds. And we're also going to talk about this 100% program, which actually doesn't have any specific area. You can get that in any location. So how much can you get? St. Louis County has $3,000. St. Louis City has $3,500. Jefferson County, $5,000. Florissant has $3,500. For those of you that sell in St. Charles, $10,000, huge. They just increased that from $5,000 to $10,000 a few months ago. So a buyer looking to purchase in St. Charles County or city, 10 grand. The 100% program, no limit, will lend you as much as you need, up to 3.5%. So some different rules for some different areas, and we'll talk about that in a little bit more detail as we go through the webinar. There is a chat feature on this webinar, and if you do have some questions, pop them in there. I am not going to answer the questions and stop the flow of the webinar, but I will answer the questions at the end of the webinar. So if you do have some questions, feel free to chat, put them in the chat box there, and I will answer those questions at the end. So let's talk about the mortgage guidelines. They will not allow any of the new non-QM loan products. It has to be a traditional type loan, a conventional loan, an FHA loan, a VA loan, a USDA loan. And the FHA 100% loan program is its own standalone product. And again, we're going to talk about that on its own because it is totally different from the grant funds. Basic guidelines. You need a minimum credit score of 580 to qualify for the grant money. So again, you don't have to have perfect credit. 580 is the middle score. As most of you know, there's 3 repositories: TransUnion, Equifax, and Experian. Each has their own scoring model. We will take the middle score of the 3. So if you've got a 600, a 580, and a 550, we're going to take 580. So it's going to be the middle score. On the FHA loan program, slightly higher standards. You need a 620 credit score for that program. Debt ratio cannot exceed 45%, and the client still needs their own money into the deal. Got to have skin in the game, but they only need $1,000 of their own money into the deal. That money can be their earnest money. It can be their earnest money, their inspection fees, a combination of all of that. So if the client is getting a home inspection, they're putting $500 down as earnest money. Their inspection is $500. There's your $1,000. We just need to verify that they have $1,000 of their own money into the transaction in some shape or form. Maximum sales price. This is going to vary from area to area. For the grant money, most of it is $176,000. So you're kind of limited there. You can only go up to $176,000 in order to use the grant money. So people buying in St. Charles, they can get that 10 grand, but the sales price is capped out at $176,000. New construction goes a little bit higher. I want to say it's 220,000, might be 230. Can't remember. It's somewhere around there. But for an existing property, it can be a condo, it can be single family, 176,000, you're maxed out at that sales price. For the FHA 100% program, no limit. You can go as high as FHA loan limits are concerned. And they all just increased, remember. But again, the rules, the interest rates, the closing costs are a little bit different on that program. And I'm going to explain that to you when we get to that point. So funds to close. If you got 10 grand in St. Charles, you probably don't need any. You're probably going to have enough there because your down payment on $176,000 is going to be around 5 grand. Your closing costs are going to be around 5 grand. There's your $10,000. If it's in other areas like St. Louis County, Florissant, Jefferson County, where you've got less money, you're still going to need probably to come to closing with some money, because although we're going to take care of the down payment or most of it, you're still going to have closing costs. You know, obviously the seller can pay for those too, but we will need to verify the funds to close. And it can be a gift from a relative. That is still allowed in this scenario. You can borrow money from a 401k plan. That's still allowed in this scenario. And obviously you can just have your own funds. Maybe people have been saving money in a checking account or a savings account. That money does need to be verified and seasoned for at least 60 days. Income limitations. There are lots of rules and regulations with the grant money, and the income limits for 2019 and 2020, they all went up, but your clients cannot earn any more money than this. So a single person purchasing a property cannot earn any more than $45,550. Now, if that person is married and their spouse does not work and they have 2 kids, you're now looking at 4 people in the household. So that income just jumped up to $65,050. If you got 5 people in the household living in the home, even though they're not on the mortgage, even though they're not on the deed of trust, these are the numbers that we're going to use. So you may have like a married couple, 2 kids and a grandparent. Now you're at a 5-person family household, 70,300. Now that grandparent probably gets Social Security income. We will count that income in the calculation for the 80% of HUD median income. So that's basically how it works. Just to recap, you've got a married couple, one of them's a homemaker, one of them works, they have 2 kids. You're looking at a 4-person household. That person can earn up to $65,050. If they earn more than that, they're not eligible for the down payment assistance money. But they might be eligible, in fact, they will be eligible for the other FHA loan program that I'm going to talk about here in just a few minutes. Lots of rules, so we're going to follow the rules, obviously, and I'm going to go over those right now for you. As you all know, get pre-approved. That's the first thing that you want to do. Lots of seasoned real estate agents on the call here today. Everybody knows they need to get their clients pre-approved. You don't want to be spinning your wheels with someone that is not approved or has a lower credit score. Once they're pre-approved, we will send the information out to the for the grant money so that they get approved on that, because there's another set of approval now. We need to make sure that they're approved for the grant money. They don't make too much money. So there's an eligibility requirement there. Your client will go online. They will complete an 8 hours of home ownership counseling. They can do that on their computer at their leisure. They can do it in 8 hours straight up, or they can do it in chunks. But they do need to complete that 8 hours of home ownership counseling. Once that is completed, they'll be contacted and they'll do a one-on-one session with a counselor to make sure that they're ready for home ownership, and they put them in a homeowner ready status. Once they're in that homeowner ready status, they've already been pre-approved and they can start looking at homes. Both the home buyer and the property must qualify and be eligible for the down payment assistance program. What I mean by that is we don't want the client to purchase a problem. We don't want them to buy a short sale or a foreclosure that needs a ton of work. Quite frankly, it's not going to pass the inspection. It's just not going to work. I know a lot of clients want to buy everyone wants to get a deal, right? Everyone wants to buy that short sale or foreclosure on pennies on the dollar and build a bunch of equity pretty quickly. This is not that program. This is not going to work for them. It needs to be in a move-in ready situation, and there will be inspections that provide that information. Again, they must have at least $1,000 into the transaction. Household income must not exceed 80% of HUD's median income, and regular financing. You know, we're not going to do anything funky here. It's not going to be any high interest rate, non-QM type loans. It needs to be a standard type mortgage. And remember, the seller can still pay for the closing costs. So you can have the client qualify for the down payment assistance program. Maybe it's St. Charles. Maybe they got 10 grand and that covers everything. Well, if the seller's still paying for the closing costs, we can take that $10,000 and we can pay that loan down even more for them. So instead of putting down 3.5% or 5%, maybe we can put 10% down or something like that and just make that situation much better for the client. So your client qualifies. Now what? Well, there's more rules. So we are going to review the rules because each fund has a different set of rules and you and your client need to be aware of these. St. Louis City, St. Charles, and Jefferson County are all forgivable. So St. Louis City is 3,500. St. Charles is 10 grand. Jefferson County is 5,000. They're going to pay 0% interest, and that loan is forgiven after 5 years if they're still in the property. Pretty cool program. At any time during the 5 years, if the home buyer decides to move out of the property or sell the property, they're going to pay that money back, and it's going to be prorated on the amount of time that they spent in the home. So if they lived in the property for 2 years, they're going to pay 3/5 of the money back, depending on how much they got initially. St. Louis County is a 0% interest again, but it's deferred. It has a due on sale clause. The money is always due back to the county, but no interest, no payments. So basically, you're borrowing that money from St. Louis County for as long as you need it. If you're in the property 20 years, you're going to pay that $3,000 back when you close in 20 years' time. But again, no interest is accruing over that period of time. So different rules for different areas. Let's look at a $75,000 sales price. I always like to look at the numbers and drill this down a little bit just to show how powerful the program really is. And we can do these webinars jointly if you guys are interested with your people. If you've got some first-time home buyers and you want to do a webinar, we can do a joint marketing webinar, and we can brand it to you and me, and we can show your clients how this works and really how powerful the program is and really the value of home ownership. So let's look at a $75,000 sales price. You're going to need a little over $6,000 down. That's 3.5% down. Let's say your closing costs are $5,000. So in a normal transaction, your closing is turning up to the table with $11,125. Let's say they're buying in St. Charles, $10,000 in grant money. Remember, they've got to have $1,000 into the deal. Let's say they put $1,000 down in earnest money. In this scenario now, instead of $11,000 at closing, they just need a little over $100. That's pretty powerful. Purchasing a $175,000 home and basically coming to closing with no money. The principal and interest payment on that scenario is going to be about $820. Let's say homeowners insurance is around $100. Real estate taxes are around $200. They're going to have mortgage insurance, of course. So their total payment is a little over $1,200 per month. Let's compare that to rent. So if they're renting at $1,200 a month, and the average rent in the United States right now for a two-bedroom apartment is $1,200 a month, according to the Washington Post. So $1,200 a month doesn't sound like a whole lot, but if they're in there 5 years, they just paid their landlord $72,000. So month to month, $1,200 doesn't sound like a whole lot, but if you amortize that out, even over 5 years, they just paid their landlord $72,000 and really have no benefit at all, except a roof over their head. Let's compare that to a purchase of $75,000. A purchase of $175,000 after 5 years, because instead of spending $72,000, it actually works the other way. They're amortizing their mortgage. They're actually paying it down little by little every month. The principal balance on that $75,000 purchase after 5 years would be $155,416. So instead of spending $72,000, they've netted $19,000 in equity in their property. They should get tax benefits for the mortgage interest that they've paid. So they'll pay less taxes at the end of the year. Remember, real estate taxes are also tax deductible. They'll pay less taxes at the end of the year. And finally, their property should have appreciated in value over that 5 years also. And depending on what area, depending on what's going on with the market, we all know that fluctuates up and down, but you could probably say 3 to 6%, something like that. Lots of benefits to being a homeowner, and a lot of people just don't realize it because they're stuck in that rental situation. Let's talk about this 100% loan program. It's a little bit different. It's not for everybody, but it is another option. So let's get into this a little bit because it has less restrictions, but it's not quite as appealing as the grant money. Interest rates are a little bit higher, closing costs are a little bit higher, but it is another option. So I just wanted to educate you guys and make you aware of this program. It has a 3.5% down payment. So right away you're saying, well, hold on a minute. It's a 100% loan program, but now you're saying it requires 3.5% down. Well, it does. But simultaneously at closing, the client will get a second mortgage for 3.5%. So it covers the entirety of the down payment. The second mortgage is calculated at a 0% interest rate and is forgiven after 36 months. So after they make 3 years of on-time payments, that second mortgage goes away. Now think about this. You could get a $300,000 home on FHA now. That requires $10,500 down payment. We could do that second mortgage for that. So this gives us a lot more flexibility. It does not have any boundaries as far as location is concerned. You can go anywhere with this program. There's no, there are income limitations, but they're way, way higher, nearly $90,000 for this, for a single person. So most people are going to be eligible for it. Doesn't have any location boundaries, does not have the sales price restriction either. So it has some more flexibility to it. Minimum credit score is a little bit higher. You need a 620 credit score. Income limits are at 115% of the HUD median income limit. So instead of 80%, you're at 115%. That's way higher, and most people are going to be eligible for that. Bad news is you got higher rates, you got higher closing costs. So we'll talk about that here in just a little bit. This program really works best with seller concessions because remember, this is for a consumer, this is for a buyer that has limited funds. So we're giving them 100% of the sales price in the form of a mortgage, but they need to come up with their own closing costs. And the closing costs on this program are a little bit higher. They can refinance on this program after 36 months of on-time payments. So again, they're going to pay a little bit higher interest rate on this program, but after they've been in there 3 years, they can do a streamlined FHA refinance to a lower interest rate or even a conventional loan at that point and reduce their costs. The interest rate on that program is about a percentage point higher than a normal loan. So let's just say FHA on a 580 credit score. Well, you're not going to get the best rate on let's do 620 because 620 is comparing apples to apples. A 620 credit score on an FHA loan is around 4% today, maybe just under, in the high threes. This interest rate on this FHA loan is going to be close to 5%. You are going to need your closing costs on this. We've already said that's going to be about $5,000. In addition to that $5,000, this FHA loan also has an origination fee, which is going to be about another $4,000 to $5,000. So the client needs about 10 grand to do this deal, but the seller can pay for all of that. And remember, the seller cannot pay for any of the down payment. So this program takes away the down payment restrictions from the buyer. But now we need to work with a seller that is willing to do seller concessions. Maybe you go in at list price, maybe you go in slightly above list price with the seller paying for the concessions in order to make this deal work. Again, not for everybody. I just wanted to educate people on this program because you're going to be hearing a lot about this program in the coming weeks. It's out there and it's being pushed hard by the wholesale lenders. And again, we looked at it. Pretty neat program. It's not for everybody, but it does give you an option. We are actually going to be doing a video blog on this tomorrow on our YouTube channel, and I'll give you information on that. So if you want some more details on this, we're going to do about a 5-minute video on our YouTube channel tomorrow explaining this program in a lot of depth. So I'll give you the link on that in just a second. All right, let's talk about credit. So how does credit work? Well, it's extremely scientific. What we know about credit is certain actions dictate certain results. If you do something, your score will go up or it will go down based off of those results. The biggest segment of your credit is payment history. It represents 35%. So pay your debt on time. If you can pay your debt on time, you've just taken care of 35% of your payment history. The next biggest item, which a lot of people are not really aware of, is utilization, the amount owed. That makes up 30% of your score. What I mean by that is it's revolving debt. So if someone has a credit card and the credit card limit is $10,000 and they owe $9,000, that's going to kill your credit score, even if you pay it on time. The credit companies, the credit card companies, the credit bureaus like to see debt utilization of 30% or less. So if you have a $1,000 credit limit, don't charge any more than $300, or don't have a revolving balance of any more than $300. Keep that at 30% or less, and that will really help your score. So if you have 1 or 2 credit cards that are maxed out, your score could get destroyed even though you're paying everything on time. Just look at those 2 segments. That makes up 65% of your credit score. Pay your bills on time, keep your credit utilization in line, and you're going to have a good score. Length of credit is the next thing. So if you have an old credit card and you haven't used it in a while, a lot of people say, close it, cancel it. Absolutely not. I would open it again. I would use it again. I would put a tank of gas or some groceries on it to regenerate that length of credit history, because the date of last activity, we call it the DLA, is very, very important on a credit report. We look at that date of last activity. It gives you depth of credit. So if you've got a credit card, maybe a store card or whatever, that is 5 years old and you haven't used it, it's really not doing you any good. But if you use it again, it reactivates that history. So now you've got a 5-year history of credit depth. It's vitally, vitally important. And the last 2 are new credit and types of credit. Types of credit, stay away from payday loans. A, the interest rates are over 400% sometimes. B, they're not deemed as very good lines of credit, and that will actually hurt your credit even having one. A new credit is like inquiries and stuff like that. And everybody in the mortgage industry and the real estate industry knows not to have a bunch of new inquiries, because that drives your credit score down. So I hope that helped with a brief explanation on credit. If you want more information on credit and how it works, feel free to reach out to me. I'll be happy to give you a one-on-one on that and help you with that. So basically, new trade lines, accounts, make sure you pay stuff on time. Keep your credit utilization in line. Do not pay off old old credit cards or cancel them. And actually, this one I didn't talk about, and it's very, very important. Do not pay off old collections. So a lot of people, when they're getting ready to purchase a home, maybe go see their loan officer to get pre-approved, they start freaking out. Oh my God, I got a medical collection. I've got a collection to Verizon Wireless or whatever it is. I'm going to pay that off real quick. Remember what I just said about the date of last activity? When you pay a collection off, it reissues that date of last activity. So maybe that Verizon Wireless collection was from 5 years ago. If you just paid it off, now it's from today. So you've now got a new collection instead of a collection that was 5 years old. It can kill a credit score. So I always tell people, talk to your loan officer, make sure they understand about credit before you start doing stuff, because paying off old collections can be the kiss of death to your short-term credit score. It will make your scores drop like a rock. Lender thresholds. Okay, so I think we all know what different lenders do with different scores. I've seen FHA down to 500 with some lenders. Quite frankly, the stars have to align for that to happen. I like to be in the real world and realistic. 580 is pretty realistic. We can do deals all day long at 580. Anything lower than that, the stars kind of have to align. VA pretty much the same way. I've seen lenders say 550 on a VA. 580 is pretty realistic. USDA 620 conventional is hard coded in at 620. You cannot get a conventional loan if your score is less than 620. It will not go through the automated system. So those are your basic credit score requirements. All right, let's talk about renting. I love this program. It's my company, so that's why probably. But we developed this program out of the need really to provide some additional credit trade lines, credit sources to clients. Coming out of the market crash in 2008, 2009, 2010, a lot of people that lost their homes, short sales, foreclosures, bankruptcies. So we started to be very proactive in that field. We started teaching people about credit, educating them on how that credit score moves up or down. What we found was that a lot of those clients went back into rental because obviously they had a foreclosure, they had a bankruptcy, they couldn't buy again for a number of years, and they started renting again, but they weren't getting any love for their rent payment. It wasn't being reported to the credit bureaus. So we reached out to the credit bureaus and we formed a company out of that business model. We actually report rent history to the credit bureaus, and it's a phenomenal product. It can really help people build their credit score overnight. It can really help people move that credit score up if they need a quick boost. So how it works is we simply report their ongoing rent payments each month that they make to increase their scores. Now that's going to be a slow burn. That's going to, each month that they pay their rent, we're going to report it. It's going to increase gradually over time. We can also go back in time. We can report the last 2 years of historical payments for a huge boost to the credit profile. This is really, really cool. So we can go back 24 months, grab that 24 months history, pop it on a credit report. Now you have a seasoned trade line for the last 2 years. And remember what I said about length of credit? It makes up 15% of your score. We just added a seasoned trade line for 2 years onto somebody's credit report. It's going to impact 15% of that score. If it's paid on time, it's going to impact 35% of that score. Remember, that is the percentage of timely payments. So we just impacted somebody's credit profile by 50% using those two segments. Very, very powerful stuff. A higher credit score will get you or help you get approved for a home loan. If you're already approved for a home loan, it might get you a better credit score. Maybe you move up from 620 to 660 or 660 to 700. What a better credit score is going to get you is A, it's going to be easier to get you approved. B, it's going to get you a lower interest rate because you have the Fannie Mae loan leveler loan adjustments, which are based off of credit scoring, or you'll get lower closing costs when you close also. We just saved a client on using our program about $3,000 in closing costs by bumping their score up about 40 points. What a difference that made at closing. So, this can really work very, very well in a number of situations. Maybe you've got somebody in a planning mode. Maybe they're not ready to buy right now. Maybe they're going to buy in 6 months or 12 months. Well, still put them into this program because it's going to help build their credit over time. And insurance companies base their premiums off of credit scores. They'll get lower interest rates on their credit cards, which will help them pay their credit cards off faster. 60% of employers now pull credit in the hiring process. So that little 3-digit number we all call a FICO score, vitally, vitally important. It's very important that that score is as good as we can get it. And for everybody that's renting, this is a really effective way of increasing that credit score. So what are the costs to enroll in the program? $25 to enroll, one-time fee. The client will pay $8.95 every month for as long as they're in the program. They can cancel that at any time. And if they want to go back 24 months, it's a one-time cost of $99. So $25 to enroll. They're going to pay $8.95 every month. We just withdraw that on a credit card or a debit card, or they can enroll under PayPal. And most people do the 24 months historical reporting because it gives them the biggest bang for their buck. So we try to make this program as affordable as possible so that everybody can participate and everybody can enjoy getting their credit score improved. There are over 113 million renters in the United States right now. This is a huge market. It's a great opportunity for real estate agents to market to renters. And we do this all the time. It's a phenomenal program. So our rent reporting platform actually provides us with a lot of leads that we can turn them into home buyers. And we do that all over the country. There are currently, and this is a running total, this is the exact numbers as of last Friday. There are currently 113,868,645 renters in the United States right now. Nearly 24 million landlords in the United States right now. Every day, there are 2,600, nearly 2,700 new renters being added to these numbers. So if you look at these numbers, renters almost make up a third of the population. It's crazy stuff. So it's a big, big market. And you can be very proactive in marketing to these renters and letting them know that, hey, did you know that your rent can now get reported to the credit bureaus and could increase your credit score? That's another way of saying, hey, are you ready to buy a house soon? It's more of a subtle approach, I think, and it can really work well. Social media. We have a Facebook page. I would like everybody on the call to like our Facebook page today. That would be awesome. We have just started a new YouTube channel. It's called Rent Reporting. And if you can join that YouTube channel too, we do videos every week about a number of different things. Again, tomorrow we're going to do this 100% loan program and chat about that a little bit. In 2019, there were over 11,000 people that liked our Facebook page. So if you can continue to do that, that would be absolutely awesome. It's Facebook at Rock the Score, and go to YouTube and just look up Rent Reporting and join our YouTube channel. Lots of really cool stuff on that. And again, we are going to be starting to interview real estate agents and people in the industry about the market and about different things that are going on. So if you would like to be involved in some of our videos on a weekly basis or monthly basis, just reach out to me and let me know. We're always looking for good content and interesting people, and just try to make that a fun channel. That's basically the webinar. I try to get through this as efficiently as possible for everybody. I really appreciate you attending. If you have any questions for me, you can call me on my cell phone. The number's there. You can also email me at my Rock the Score email address, and I'll be happy to chat with you about whatever questions, concerns, or comments that you have. Because this is a fun business, that's my stale suit and tie photograph. I always say, the mortgage business, yeah, I've been doing it for 25 years, but it's not much fun. My rent reporting business, that's a lot of fun. So I got my fun picture in here instead of my mortgage picture. And I always like to end with that. So, but anyway, yeah, feel free to reach out to me. You can text me or call me on that number, and you can